You got to be flipping my flapjacks. Look at that 5-day chart. What I'm showing you in front of you right there is a 5-day chart of Tesla, Hims, Coinbase, AppLovin, Hood, and Palantir stock. Why am I showing you those? Because those are many of the most popular retail trader investor stocks you're going to find. And matter of fact, I would say the far majority of people watching this video right now, you own at least one of those stocks. Let me know in the comment section, but I would almost guarantee almost every single person watching this video, you own at least one of those, right? Tesla has now fallen in the past 5 days about 7 percentage points. Him stock with the after hours move is now down about 30% in the past 5 days. Coinbase stock is down over 17% in the past 5 days. AppLovin's down over 20%. Hood's down over 20%. And Palantir's down over 26% just in the past 5 days. This starts to worry people. People start to say, what's going on here? Like, these were some of the most popular momentum names you could find in the market, and now they're just dropping off a cliff. Meanwhile, you have Warren Buffett, arguably the most legendary stock market investor in the history of the stock market, loading up on cash. Look at this headline here. Berkshire Hathaway has $189 billion in cash now at this point in time, cash and short-term investments. Oh, wait a minute. I'm sorry. That's from June 2024. No. Now? Oh, here we're up to date. $334 billion in cash and short-term investments. Berkshire is loaded to the hill with money ready to rock and roll if the stock market has any sort of crash. That starts to worry people, right? Now, meanwhile, you think about like how much Warren Buffett could buy. Like, he could buy the entire Bank of America company with that cash pile. He could buy the entire Alibaba company. He could buy the entire Coca-Cola company, the entire Salesforce company, the entire Chevron, the entire Samsung company. He could buy the whole dang thing with that cash pile. That's how extreme it is now at this point in time. Meanwhile, you have some of the strongest stocks in the stock market starting to falter, like Walmart, Costco, right? Look at how fast these Costco puts have appreciated. They're up 23%, like in a snap of a fingers, and Costco hasn't even come out with any news, right? So in this video here today, we're going to talk about two main subjects. Why I'm not scared. We're going to talk about why I'm not scared of a full-blown stock market crash. I'm going to take you through the data, the numbers, and show you exactly why I'm not scared of like, oh, S&P 500 is going to have this massive epic crash, right? Second thing we're going to speak about is when I will get scared about a crash. And so we'll go through that in this video today. And so I hope you guys enjoyed this. This is going to be a data-focused video. This is a beast one. And this is a video that, you know, if you're going to put a video like this together, you got to be in this market a long time. So I appreciate y'all being here. The only thing I need from you guys, smash that thumbs up button. I hope you can do that for me. This video took a lot of thought, intention, and detail to put this one together for you guys. So all I need from you, hit that like button. And if you want to be subscribed here to the channel, you can certainly subscribe. 830,000 plus subscribers strong. I appreciate y'all for being here year in and year out. Okay. Alrighty. Let's get rolling. This is very important. I start right here. What I'm showing you is a list of the biggest market cap stocks in the stock market. Now, the reason I want to start there is you got to understand the biggest weights in the S&P 500 and the Qs are by far and away the biggest market cap stocks. So there could be a lot of weakness in, let's say, smaller companies, and it won't actually affect the indexes very much at all. There could be a lot of strength in the smaller companies, and it won't affect the indexes much. The indexes are really going to be felt based upon if Apple, nvidia, Microsoft, Amazon, Google, McDougal, Saudi Aramco, Meta, Berkshire Hathaway, Tesla, if those stocks are moving up, the whole market's going up. If those stocks are all moving down, the whole market's going down. So this is why I want to start here and talk about these companies at the top and if they're set up for a crash or if they're set up for good times ahead. Because these ones will dictate if the stock market is going to go into a full-blown crash or if we're going to actually have fun times. This is much more important than what the Federal Reserve is going to do. It's much more important than what Trump and Elon are going to do. Any of that stuff. This is what matters the most, okay? So you got to look at valuation. You got to look at expected growth rates for these sorts of companies, right? So if we start at Apple, Apple's the biggest company. It matters the most to the stock market. It's the most important. So Apple trades at a forward P of, let's call it low 30s, 32, right? Maybe they come in and beat numbers throughout the year. So maybe it's a 30 or a 31. But let's say it's a 32 forward P based upon analyst estimates, right? Revenue growth for Apple should be in the 7%-ish range for this year. So I would call Apple a little rich, but it's not like it's some ridiculous valuation like Apple set up for some epic crash and load up on put options on Apple. It's not really set up. And they got a very stable business model. So investors are always going to will be willing to pay a premium for Apple because their services revenue nowadays. It's consistent. The money just pours in and pours in. They're basically like a government in terms of they just get this tax on the entire app store, and any popular apps on there, they just tax them, man. They get that 30%. So if some big AI app becomes super popular and everybody's downloading it over the next, year, guess who's going to make a fortune off that? It's going to be Apple. They're going to be taking their 30% tax, right? So Apple, a little rich, but it's nothing crazy, okay? NVIDIA looks fine here. Forward P of 32 on NVIDIA, right? With revenue growth of 50% plus expected over the next year. Now, keep in mind that you can make a strong argument that NVIDIA is actually looking very undervalued here, but I wouldn't go that far to say NVIDIA is super undervalued just because growth rates should drop significantly in 2026. I expect NVIDIA probably to grow more in the 5 to 15% revenue range in 2026. So that's why I wouldn't say NVIDIA is a screaming buy. Like if NVIDIA kept growing revenue at 50% a year for the next several years, like NVIDIA is a steal deal here and you're going to make a fortune on this stock. I don't see that being realistic. I see 2025 being another great revenue year, and I think we're going to start to see a major slowing of buying these chips in 2026. And so I would say NVIDIA is fine here based upon the valuation. If NVIDIA was trading at a 60 or 70 forward P, I'd worry about it because I'd be like, okay, yeah, growth rates are going to be great in 25, but probably not in 26 or 27. We're fine here with NVIDIA. Microsoft, 28 forward P, revenue growth expected around 14% next year. Microsoft's fine. Microsoft's not set up for some massive crash. Their business model just recurs and recurs. They have their cloud revenue. They have their, obviously, Teams revenue. Like, it's just consistent, man. And so Microsoft looks good. If anything, Microsoft might actually look a little undervalued here. Microsoft actually might look good here, okay? Now, when it comes to Amazon and Google, Amazon looks fine here. Forward P of 33. That's very low forward P based upon, this is one of the lowest forward Ps, if not the lowest forward P you've ever seen on Amazon in the company's entire history. This is extremely low for Amazon. And the company is going to likely grow double digits for years and years to go in the future, outside of some colossal recession. But even that, like e-commerce just continues to get more popular. Their advertising platform continues to get more popular. Additionally, their Amazon Web Services, and there goes an Amazon Prime truck, literally just passed by the window right in front of my house right now. This is perfect timing in regards to that. Like Amazon set up fine. So Amazon looks fine, if not good here. Google trades at a forward P under 20. The growth rates for Google should be, let's call it mid double digits, so probably anywhere between 13 and 15% for Google this year. They look good. Saudi Aramco, that one's kind of crazy because a lot of it's going to depend upon what oil price does over the next year. So, that one's kind of all over the place, but I think they're probably fine. Meta looks good here. 25 forward P. The company comes in and beats numbers quarter after quarter after quarter. So that forward P is probably in reality much lower than what it says here, okay? Don't be surprised that the forward P on Meta is actually 22 or 23 or something like that. So even at a 25 forward P with revenue growth of 17% expected for this next year, looks good, man, looks really good. Berkshire Hathaway, around a 24 to 25 forward P with 4% revenue growth. You say, well, maybe that's a little high. No, because what did I show you guys before? They're loaded to the sky with cash and short-term investments. So you're going to pay a little bit of a premium for Berkshire Hathaway, not just because of the stability of the great business models, right? But because of that massive cash hoard. And if we do have any market dynamic where the market goes down in a significant way over the next 6, 12, 18 months, Berkshire is loaded to just buy everything in sight. So I think Berkshire looks really good here. Like if you told me I had to go buy $100,000 worth of Berkshire stock tomorrow, I wouldn't mind it. Like, it's not like I want to do it, but at the same time, would I mind? Not at all. Like, I think I'd be just fine over the next 5 years buying $100,000 worth of Berkshire. Bottom line is 5 years from now, that $100,000 would probably be worth $150,000 or $200,000, right? Tesla, high, no doubt, forward P 119. Next year, revenue growth we'll see probably in the 10 to 20% range. So no doubt Tesla trades high, but it's Tesla. Tesla always trades high, right? So the moral of the story in regards to these stocks is there's nothing to go off of valuation-wise here that makes you say, oh my gosh, we're destined for some big crash. These valuations are ridiculous. When you look at the growth rates of these companies and you look at the PEs and the forward PEs, nope. It's fair. Like they're fair, if not many of them are actually undervalued here and are actually a buy. Like if you buy Meta stock today, Google stock today, Berkshire Hathaway stock today, Amazon stock today, right? Like I think a lot of you're going to look very good. Even Microsoft, I think, if we fast forward even a few years from now, I think you're going to have made a lot of money on many of those stocks. Even if we fast forward 12, 24 months, I wouldn't be surprised. So do keep that in mind, okay? Now, the other beautiful thing we have here is not just a game of forward Ps versus growth rates. Also in, how a business model is valued over time, it's also about expectations, okay? So stock market plays a big game of expectations. Can you come in and beat numbers throughout the year, right? You come in and beat numbers throughout the year, people feel good. There's a good sentiment in the market. There's a good sentiment around stocks. You come in and miss numbers, you do poorly. You miss your revenue expectations, your EPS expectations, your margin expectations, your stock gets hammered. That's what happens, right? I've been watching all the big tech companies have reported now, other than nvidia, and they'll be reporting shortly. They've all set it up where there's not a lot of expectations for any of these companies, just to be quite frank. There's low expectations. Either the companies have guided pretty modest revenue growth, or analysts are just kind of like in a state where they're not expecting a ton from these companies. And so we're not going in with some sky high expectations for 2025 where it's like, everybody's expecting 30% revenue growth from these companies, and then they come in with 10 or 15% and everybody's like, what happened? No, we don't have that situation. And so the setup is very good for this year. If these companies all would have came in with massive expectations and they all had crazy guides for big, huge growth rates, I would be worried, because then I'd be like, geez, if the economy weakens this year or something like that, like these companies are going to have trouble hitting numbers, and then that could get into a whole bad dynamic. Low expectations are set for these companies, right? So that right off the bat is one of many reasons why I'm not actually scared in this market, right? Next up here, we had a very bad year in 2022. Anybody that was in the market in 2022, you remember, right? Tremendous year to be buying stocks, especially in the back half of 2022. You were getting steal deals all over the place. But if you were in the market, you got likely smacked, right? In 2022. I got smacked in 2022. Everybody got smacked in 2022. It was invested, especially if you're invested in any growth stocks, right? With that being said, why did we have 2022, right? Keep this in mind. Going into 2022, we were coming off 3 banger years for the S&P 500 and the NASDAQ, right? This is S&P 500, a 29% return, 16% return, and a 27% return, right? And then we got smacked in 2022, right? So first off, we don't have a 3-year banger setup. We have a 2-year banger setup, right? Now, additionally, keep this in mind. In 2023, right, a lot of those gains were just get back. Like that was just getting back what we lost in 2022 because we came off of a really rough year. So 2023, although it looks like, wow, what a banger year, up 24%. Yeah, we were down 19+% the previous year. So a lot of that was just get back. So the real gain between 22 and 23 is only a few percentage points, right? Now, 2024, banger year for the market, right? S&P 500 up 23%. And then 2025, we don't know what the situation is. But the fact is, we didn't come off 3 banger years yet, right? Additionally, remember, we came off very high valuations. The big tech companies were all looking very richly valued in that fourth quarter of 2021. They're all trading at very high price to sales ratios, forward Ps, and those sorts of things. And what ended up happening was they had ridiculous comps, because we know what happened in 2021, right? World starts to open back up, but then you just had this massive stimulus that was out there. These companies started posting phenomenal growth rates in 2021. Well, yeah, all these companies post great growth rates, and what happens in next year? You have to comp against those numbers. And by the time you got to the back half of 2022, these companies were comping against ridiculous comps that were brutal to try to comp against. And so you know what happened? They started to miss numbers. They started to miss expectations. They had to start bringing down numbers, bringing down guidance, and it was a whole ugly situation. And the numbers were pretty brutal for many of those companies in the back half of 2022 through the first half of 2023. And so that's why that ended up happening. We don't have that same setup right now. We don't have sky-high valuations for those stocks based upon looking at the forward Ps versus growth rates. We don't have crazy expectations for these companies, right? And we don't have some ridiculous comps. The only company that has ridiculous comps they're going to have to comp against, really, is one company. Who is that? NVIDIA. NVIDIA is the one company that, if you want to look at big tech, their growth rates have just been ridiculous. And that's going to be a problem for NVIDIA eventually. When all of a sudden they would say, we're probably only going to grow revenue 5-10% for a year, it's going to be an issue when people are used to 50 and 100% and 200% growth rates, right? But the rest of the stocks, you haven't had that. So that's another reason why I'm not very scared in this market. The next reason why I'm not scared is this right here. If we look at the public account, right, and we look at the stocks I'm positioned in, it's a lot of very strong companies. You start at the top, Meta, extremely strong company with a valuation that makes a lot of sense. And so am I worried that Meta is going to crash 50% and go down to $300 something? No. That would be the biggest gift in the history of gifts for any investors that are looking to buy if that happened and Meta goes down to 350. But, that'd be the biggest buying opportunity in Meta since, it went down under $100 in 2022. But don't hold your breath on Meta going down to $300 something. So Meta's looking really good, right? Tesla's very weak as far as the business model right now, but they still set up very well in the auto industry. They got the strongest balance sheet, arguably, of any automaker. And their income statement is still very respectable in terms of their total revenues. If you look at their profitability from many various things, and you think about the long-term trajectory of the wave they're in front of, it looks pretty strong from that perspective, but the short term looks weak. No debating that, right? Amazon's super strong like Donkey Kong. We know what it is. PayPal's super strong like Donkey Kong. AMD, I know it's a hated stock, but the business is extremely strong. And the way Lisa Su has positioned this company for the next several years is very strong. The company is set up in a very good situation. Palantir, very strong company position, very strong product portfolio, right? And very strong income statement and balance sheet. But with that being said, the valuations, even after this crash we've had recently, where the stock has fallen, 26%, 30%, whatever, in a matter of a very short amount of time, is still very high valuation, like sky high valuation even still. So Palantir is strong and weak at the same time. Nike's numbers have been very weak recently, but the company's setting up very well for the long term here. The company's looking really strong, and the stock is continuing to see momentum. We're almost positive now on Nike, right? And that was one we were extremely negative on not even that long ago. Right now, we're almost to gains on Nike. That's incredible. Cheesecake, strong like Donkey Kong. Their numbers are extraordinary. Like, even if the economy was slowing or something like that, you don't see it in Cheesecake numbers. They were talking on the conference call about 11% up comps for Flower Child on a year-over-year basis. Come on, man. You got to be flipping my flapjacks. Things look good at cake, right? Celsius, numbers have been weak recently, but they're setting up very well for the second half of 2025 and then into 2026, especially with the new acquisition they had. Celsius is going to likely start reporting phenomenal growth year over year, probably starting as early as the second quarter of this year. The second quarter, I'm expecting to start to see the growth, and then third quarter, fourth quarter, it's going to be a rocket ship ride. EL, blue skies ahead for that one. Obviously, EL's been very weak, but I think people are understanding like there's a great opportunity in EL over time. So blue skies ahead. Revolve looks strong. Fubo, blue skies ahead in regards to that, especially as soon as that Disney deal gets done. Don't be surprised if that stock goes from $4 to $8, like that, especially as you get closer and closer to the Disney deal actually going through. I think you'll see more and more momentum coming to Fubo. Elf's extremely strong. We know that, right? Stock's very weak, but in terms of the business model, strong as Donkey Kong. SoFi's very strong. Look at the numbers. Monster is very strong all the time. They're just a beast. They're kind of like a modern day Coca-Cola with a little better growth rates. Planet's very weak. We know that, but it's a speculative position. It hardly matters to the portfolio. $35K out of a $3 million plus portfolio is like a 1% weighting, right? And then Costco, making good money on these, but don't be surprised if I'm out of those, in a week or a few weeks or something like that. So this is another reason I'm not scared, because I'm just in a lot of damn very, very, very strong companies and diversified across. You see growth stocks in my portfolio, you see value, you see divs. If I was all in on growth stocks only and super high valuation, I'd be worried. I would be really concerned with my setup, but I've just done such a, in my opinion, great job. Not in my opinion, it's facts, actually. You look at the performance of the portfolio. Done such an amazing job positioning the portfolio for any market dynamic we get put into. Whether that means slow growth, high growth, low inflation, high inflation, whatever happens, like I own such great companies that they'll make it through the other side. They'll be fine. And their business model's set up well regardless, right? Now, with that being said, I'm going to be very crystal clear about this. I'm not screaming bullish right now either, right? I'm not like, obviously this video is about why I'm not expecting a massive crash in the stock market, but I'm also not, you don't see me, putting crazy money into the stock market right now. No. I'm still holding a good cash position. I'm buying stocks every week, right? And I'll make some deposits here and there that are kind of freak deposits, like, oh, let me throw 50K over here. But I'm not going all in this market either. Let me be very crystal clear about that. And why not? Well, we have a few things here, right? First up here is, I don't think this is super bullish, right? If you're looking, what we're looking at here is a fund manager survey and how much cash they're holding. The fund managers are basically all in on this market. This was the most recent reading here. Assets under management as a percent cash, like they're very all in this market, okay? That is not super bullish when these fund managers are basically pretty much all in the market, right? That makes it hard to get a lot of upside in regards to stocks, right? Now, the additional thing is, because some people might read this and they say, oh, this is very bearish. This means we're going to crash. No, not so fast. And here's why. There's been plenty of time periods in the past where fund managers got down to very low levels of cash, and it was actually a great time to be an investor in the market over the next few years. Look at this time. This is the end of 2010 going into 2011. I can tell you, you could have looked at this and said, oh, this is very bearish for the stock market. Listen, it was a great time to be buying stocks. Look at right here. This is the end of 2012 going into 2013, right? Fund managers got very low on cash. I can tell you, there was a lot of fun to be had over the next few years. There was a lot of money to be made in the stock market, right? Fund managers got very low on cash here. There's still a lot of money to be made over the last few years, is there not, right? So the only real tell in this chart, in my opinion, is when fund managers get over 5%, when fund managers get over 5% cash, that is a time that usually makes sense to be loading the boat on stocks. So for instance, December 2008, right? Late 2008, great time to be loading the boat on stocks. Fund managers were over 5% cash. Right here, they went over 5% cash in 2011, 2012. Great time to be loading stocks. October 2016, great time to be loading stocks. And even prior to that, right? Obviously here, April 2020, great time to be loading stocks. In October 2022, great time to be loading stocks. So whenever they go over 5%, and especially if they start going to like 6% or so, great time to be loading stocks. Great time. So do keep that in mind in regards to that chart. But still, once again, I wouldn't read it as like super bullish, right? Definitely not. I'll get super bullish when we go over 5% cash, and especially over 6% when it comes to those fund managers, right? Additionally, it's not just fund managers are all in the market. Retail's all in the market. Look at margin debt levels. $937 billion, approaching close to $1 trillion of margin debt. What the hell is retail doing? Like, what are they doing? Loading up on margin debt with these super high interest rates? I mean, it's not cheap to take out margin. That's the first thing. Like, you need to make like 8 or 9% minimum. I think actually a lot of these companies are charging like 10% margin rates right now. So you need to get like a 10% return just to pay off your margin. That's crazy, man. Your margin interest, that is. Not to pay off your margin interest. Like, what is retail doing? Like, I'm very disappointed that they're loading the boat on margin. And I'm like, this is not the time to be doing that. Like, first off, it's never the time to be loading the boat on margin, right? But especially not when you're coming off of a nearly 2.5-year bull cycle. Remember, we bottomed out this market around October of 2022, right? And so to be loading up on margin, you're way late to the game. And at these sorts of margin rates, and keep this in mind, we are now at all-time highs in terms of margin outstanding, right? 937 billion. You know, the old highest record was back here in October 2021. Retail, $935 billion of margin debt. Now, remember, back here in October 2021, remember, margin interest rates were on the floor. Like, you could get margin loans at like 3% interest rates, 4%, 5% were very customary at that time. So it was very cheap. Now it's extremely expensive to take out margin interest. And remember what happened shortly after we hit that all-time high for margin debt outstanding from the retail crowd, right? What happened? Bang, we got hammered, right? And then we kept getting hammered in 2022. So that's not a guarantee that we're going to get hammered or something like, but it's not a great sign. It's not a sign you would look at to say, oh, I feel great about the market. When you want to feel great about the market and loading up on stocks, when margin debt gets very low, because that basically means people are scared. They don't want any part of the market, right? So for instance, look at like right here. Look at like November 2022. Got all the way down to $643 billion of margin debt outstanding. And that was from $935 billion, just a year prior, right? Look at this. December 2022 got all the way down to $606 billion margin. So very low number, extremely low number. So you basically cut off over $300 billion of margin debt. It was very healthy, right? And that was a good telltale sign of like, load the boat on stocks, right? So when this number gets extraordinarily high, start to be more fearful. And when this number is very, very low, be very, very optimistic, right? I mean, look at back here. This was May 2020, right? That was a Rona shutdowns, but it was also a great time to be bullish on the market because the market bottomed in March, April of 2020, and then went through an incredible bull cycle that, look at where the market was at in March of 2020. Look at where the market was at in April of 2020. Look where the stock market is today. Look at where all the most popular stocks were in March and April of 2020. Look at them today. So you can make an argument that that was a telltale sign. Like, wow, we went under $500 billion of margin debt outstanding. Load the boat, okay? Now, obviously, I've been taking profits. This was kind of the end of 2024. This is public account profits, right? And look at this. Tesla took $157,000 worth of profits right there, right? Palantir took $132,000 worth of profits in 2024. Why? Is it because I think Tesla's a bad company or Palantir is a bad company? No. It's valuation, strictly valuation. The valuation of both those stocks started to get to ridiculous levels. And I said, okay, I'm going to start to take some chips off the table, right? And that led into the beginning of this year. Guess what I did? Took more profits. This is in the public count. I've already taken $290,000 of gains so far in 2025, just in the public count alone, right? Palantir, $143,000 worth of profits taken. Tesla, $78,000 worth of profits. Big numbers, right? But it's because I looked at the valuations. I'm like, these valuations are ridiculous, right? Meanwhile, other people think it's more fun to argue with me about, oh no, you don't know what you're doing in the market. Like, you don't know. I don't know what I'm doing with Palantir. I don't know what I'm doing with Tesla. Okay. Like you think the guy that was buying at those ridiculous levels back then doesn't know what he's talking? I think I know a thing or two, right? I think I know a little something about Palantir. I think I know a little something about Tesla. And I think I know a little something about value in companies. So when I'm saying I'm cashing, it doesn't mean I'm going to perfectly time it and I'm going to get the absolute top. Oh man, But the moral of the story is when I take profits on a stock, it's usually either because I want out of that company, I don't see an opportunity there, or I see much better opportunities for my money, or it's a situation where I think that stock's going to be dead money for the next several years, right? And that's what I looked at with Tesla and Palantir. I said, there's much better opportunities for me at this point in time, right? And so when I'm selling those stocks, I get the same argument I got when I was buying those stocks. Silly, dumb, bad decision, right? It's the same arguments I heard when I was buying Palantir $7. Same thing I heard when I was buying Tesla, 20x ago, right? On the other side. So, people would rather argue and debate. And I'm like, learn from me. I've been doing this game for a long freaking time. A long time. And playing on a high level and taking unbelievable profits over time, right? This is a video I put out. This is my favorite video I put out in 2024. If you never watched this video, watch this video at some point in time. 16 years of stock market advice in 52 minutes. Extremely valuable video. I think it's for sure, in my opinion, the most valuable video I put out in all of 2024, right? And that's, I put out some videos on this channel that are just incredibly valuable, like buy Palantir stock and don't stop buying. Remember when I put out that video and Palantir was $20 a share in 2024? This is a more valuable video than that video, right? Watch that video and don't just debate, just learn, man. I've been doing this game for a long dang time, right? I haven't built up this following by accident. Like it's a long process, right? Additionally, if you want to take things up to even to a higher level and learn from me in all my courses, pin comment down there. I put it as a pin comment almost every day. If you want to apply to join my private stock room, get access to all of my best courses, teaching you everything I got up here. It's there for you. Like, do you not want to learn all this stuff, right? Private stock groups, Discord chat, all that good stuff. It's right there. Pin comment, man. Fill out the form. Get you in there. Get you up to a much higher level, right? Now, there's a worry coming into the stock market. I'm seeing it more and more, and I'm starting to hear it talked about more and more. And it's called stagflation, right? Now, stagflation is typically categorized as an economic cycle which has slow growth, a high unemployment rate, and high inflation, right? Now, I don't think there's really worries about like a 10-10. What is a 10-10? A 10-10 is a stagflation environment in which you got like 10% unemployment and like 10% CPI, right? That's a disaster, and that's something you could look back at kind of late 70s, early 80s. We had actually that type of dynamic where unemployment was like 10% plus and then inflation rates were 10% plus. We don't have that sort of worry, but I do believe there's kind of like a worry about a 5-5. A 5-5 would be like unemployment goes to 5-something% and we have like a CPI of 5-something%, right? Which would make it very tough to get much growth in the economy and a much growth in earnings of companies, unless they're just some sort of incredible company that just has sky high growth rates. And so I think there's worries about like a tame version of stagflation really starting to creep in that could really affect the economy in the second half of 2025 and into 2026, which is, I think, a serious thing to consider. I think that's definitely a possibility, right? Now, with that being said, let's imagine for a moment, I'm over here on the side of this road here, okay? And I'm building my hut, and I have all my building materials there, and I'm building this hut. So, it can help me stay dry when the big storms come and tornadoes come, and I can stay safe, right? And so there's just a big field, and I'm just building my hut here, right? But then when I see a storm approaching, right? There's a big, massive storm there. What should I do? Here are my options, right? I could try to outrun the storm, which good luck to me outrunning a storm, because the last time I checked, storms could move a lot faster than a human could over time, unless a professional marathon runner, which even if that's the situation, I still don't think I'm going to outrun a tornado. My other option is I could just lay there in the grass, right? Or I could keep building my hut. What should I do? I think it would make the most sense to keep building my hut, right? That's the same thing in the stock market. You're going to have these storms come all the time. It's not like it ends. Right now, what are our storms? Well, we got a lot of federal jobs being cut right now. What's that going to do to the economy? In the short term, probably not good things. Long term, it might be a great thing, but short term, I don't think it's a good thing. Additionally, right, tariffs coming, like what's that going to do to inflation rate? Like, we have a lot of storm clouds out there, worries about stagflation, and what that's going to do, right? And if you start cutting how much the government's spending with all these companies, do companies have to start laying off more people? Like, it's a whole chain of events, right? Dominoes falling the whole wrong way. So we could look at all those storms and say, you know what? We're not going to do anything. We're just going to lay down. Good luck. Could say we're going to try to outrun the storm. Good luck. You're not going to outrun the storm anyways. The storm's coming, right? Or might come. It makes the most sense to keep building. And so that's what I do with my portfolio. I keep building, and I keep building the portfolio regardless if the storm clouds come or not, because at the end of the day, there's going to be new storm clouds next year. I want you to understand that. And there's going to be new storm clouds in 2027. There's going to be new storm clouds in 2028. It never ends. It's just different. It's just different storm clouds, okay? But what you find many times is the storm clouds never come to you. Like you keep building your hut. I'm building my hut there. I'm like, like, shoot, I got to build this hut as fast as possible. But what I end up finding is like, oh, the storm clouds never really hit me. The tornado that looked like it was coming, it actually diverted and actually went over there. Never had to hit that tornado, right? But the moral of the story is, if the tornado does hit, right, I'd rather be in my hut I try to build as much as possible versus just out here laying in the grass or trying to run away from it. And the storm sucks me up and throws me around like the cow in the Twister movie. Remember that, right? But more than likely, the sun's going to come out. And it's going to be a bright day, and we're going to have worried about whatever we worried about, and like then it's going to pass, and then we're going to be like, oh, what? Wow, the storm never even actually hit us. We thought it was going to be like, oh my gosh, all this stuff in it. No. Okay. Next up here, when will I actually get scared of a crash? I think that's an important subject, right? A few situations could actually get me scared that the tornado's coming and it's going to tear off the roof, right? One is if stagflation actually became a true reality. We don't have stagflation yet, but if it did actually start to hit second half of 2025, something like that, or even like over the summer, that's scary, right? Because you don't know how long you're going to be in that stagflationary episode. Does it last just a quarter or two? Or are we talking 2 or 3 years? 2 or 3 years of stagflation would be really painful and really dramatic. I don't know if that's going to happen, but that would definitely be something to be concerned about, right? Another situation is we've already seen CPI, the inflation rate, start to go up. If it kept going up and up and up and up and up, quarter after quarter for a while, that would be scary, right? That would definitely scare me. Additionally, this is what we put out to the private stock group, our investor report each week to all the private stock group members, going through a lot of data. I want to show you something that's a little worrisome here. Look at the consumer sentiment. Came in at 64.7 in February. That was down 15.9% year over year. And keep in mind, a year ago, consumer sentiment still wasn't even a good number. So consumer sentiment's been bad for the last several years, and it remains bad, right? And that's even with the change of administration and, the excitement that brought. Still, consumer sentiment is not good. Because you would have thought, because here's the thing, consumer sentiment was actually really good under Trump 1.0 prior to Rona, essentially. If you look at where consumer sentiment was 2017, 18, 19, consumer sentiment was actually really good. So I think a lot of people thought Trump gets in office, right, takes over, consumer sentiment's going to spike, everybody's going to feel good. We're not seeing it yet, unfortunately. It doesn't mean it can't come, 6 months from now or a year from now or 2 years from now. But the moral of the story is Trump's in office and people are feeling even worse. And so that's definitely, and not a little bit, but like a lot worse. That's definitely a little worrisome, right? Now, additionally, something that could really scare me. This is a 3-month chart I'm showing you right now of D.R. Horton. That stock's down 19% in the past 3 months. ITB, which is a construction index, down 22+% over the past 3 months. Pulte Homes is down 26% over the past 3 months. KB Homes down about 28% in the past 3 months, and Toll Brothers is down 34%. Not good in the past 3 months. By the way, who was buying Toll Brother puts at the end of last year? Should have kept them on a little bit longer though. I didn't get the timing perfect, but we still made a little bit on that those toll puts, right? But the moral of the story is here: if these companies continue to get worse, that worries me. I always tell you guys, like, home building is so important. It's the most important thing, in my opinion, to the overall economy. You see slow home building completely dry up, the economy is going to dry up and it's going to get nasty. If home builders, kind of go through this rough time and then emerge out 3 months from now, 6 months from now, and things start to improve, their stocks start to improve, their orders start to improve, then we can start to feel a little better. But for right now, it's definitely a little time you got to be like, oh, shoot, what's going on here? I don't like the way this is setting up, right? But with that being said, we're building a mansion here, and we got to keep building. And so in regards to your portfolio, keep building, keep buying. If you get great deals out there in the market, take advantage. Like if you own this stock, if you own a basket of 15 stocks, right? And let's say 10 of those stocks are going down because they're worried about tariffs, they're worried about stagflation, they're worried about whatever, and you liked them at the previous price, why would you not buy it when it's 10% discount, 20% discount, right? And always do remember, every dip's a buy. It's just the truth. That's the best part. There's no debating it. Every dip in the stock market is a buy. Every one of them. Show me one dip in history that was not a buy. I'll wait. There was never one. The Great Depression was a great buying opportunity. The crazy inflation and stagflation you had in the 70s and 80s, great buying opportunity. And the tech bubble, prior to the bubble and during the bubble and after the bubble, great buying opportunity. The great financial crisis, before it, during it, and after it, great buying opportunity. The Rona crash, before it, during it, and after it, great buying opportunity. 2022, before it, during it, and after it, great buying opportunity. And whether we get a crash in the market in 25, 26, whenever, great buying opportunity. Always remember that. And so that's why I was just always focused on building. There's sometimes I might be buying some puts out there. I see some opportunities for some real hedging, right? Some opportunities I see great time periods to build cash, to redeploy funds from growth stocks into value and divs, or from value and divs to growth. Like let's say a dynamic happens where value and divs go beast mode over the next 12 months, let's say, for instance, right? And Estee Lauder skyrockets, and Nike skyrockets, and all these stocks skyrocket. Meanwhile, growth stocks and tech stocks just get obliterated for the next 12 months. You'll see me redeploy money from value and divs at that time and take crazy profits. It's just the name of the game, man, okay? Been doing this game a long time, guys. Appreciate you joining me as always. Thanks so much for being here. If you're looking to take your game up to a much higher level than where you're at, pin comment down there, click on that, fill out a form, see if you can get access to that maybe the end of this week, and get you rolling. Much love and have a great day.